Good afternoon, Insignio family. We are back for another Insignio TV series. Today's February 5th, 2025. I'm Alejandro Guardiola with the Investment Solutions team. I'll be your host today. With us, we've got Tam McVie, Director of Alternative Investments at Aberdeen. Welcome to the show.
Thank you so much. Thanks for having me.
Our pleasure. For those of us who are not familiar with Aberdeen as a house, as an investment and asset manager, give us the lay of the land.
Sure, yeah. So Aberdeen's the term that we use is a global specialist in that we are a global asset manager, but we really focus on the kind of key areas where we've got really core strengths. So if you think EM, whether that's equity or debt, whether you think small cap in the equity space, we've got a very strong franchise in real assets. So think real estate and infrastructure.
Yep.
The part of the business that I represent is the hedge fund team. So I work in the Alternative Investment Solutions team, and we are a top 12 fund of hedge funds. So we run about $15 billion for predominantly institutional clients here in the States, in Asia, and in Europe. So right across the piece. So we think we've come up with something that's really interesting. It's entirely unique, which is not something that you can say very often in this business, but it's entirely unique, quite interesting, and really, it's kind of tying into this theme that we're seeing right across the advisor space of trying to get access to alternatives.
Sure. Hedge funds at a kind of sticker price level have had some rough patch. Right, popular for a while, came out of favor, and broadly speaking, what's changed these days?
So there's a couple of things around that. One is just the overall environment. If you look at the last 20 years, the Sharpe ratio that you've gotten from just being invested in the S&P 500 and maybe some bonds alongside it, so just the Sharpe ratio that you get from a 60-40 has been at absolutely all-time highs. As we kind of go into, the next decade or so, we're just starting to see a lot of the things that honestly they've been bubbling for a long time. This kind of idea of macro risk, the idea of, geopolitical issues. They've been around for a long time, but they haven't really affected particularly the S&P 500. It just has gone up in a straight line. As long as you held the Magnificent Seven, it just went up in a straight line and did so on a relatively risk-adjusted basis. I think what we're seeing now is just an environment. The biggest change at catalyst, I would say, has been the pickup in interest rates in developed markets, and that's been a real sea change, because previously you could buy the S&P 500, and in moments of stress, you knew that the Fed would come in. They're not doing that anymore.
Fed put.
Exactly. So that's long gone now. And the other thing that we're seeing now is just with the amount of focus and the dominance of particularly 7 stocks in the US, we now see the opportunity set going forward for actual stock picking and the ability to actually differentiate your returns from beta.
Sure.
As being the most favorable that we've seen in literally a decade or so. So I do take your point, and hedge funds have kind of been up and down, etc. But I think on a go-forward basis, the need for diversification is there, but also the return opportunity is there. And I would break that into 2 areas. One is higher interest rates, just generally speaking, we've found drives higher returns from hedge funds, just the way that they're structured. And the second bit is just the return opportunity and where being able to find opportunity. So just take long short equity, the dispersion, the opportunity between stocks is much greater, between sectors is much greater now than it has been for a very long time.
100%. So hedge funds, there was pushback that it's just like providing an alternative beta, expensive beta, so to speak. In a world where there's more alpha opportunities, it can cut both ways.
Sure.
Right. Hedge funds that you guys are overseeing, we're talking daily liquid as far as the instruments that are going into the strategies. Is that right?
Well, we kind of look at, so our business across the kind of hedge fund investments that we make are from liquid opportunities right throughout to kind of private credit type strategies. The different private credit's like the in vogue alternative asset class, right? But it came out of hedge funds. It's not actually enough. We've been investing in it for years, etc. But the key thing is in the buying and identifying hedge funds is a really, really difficult thing to do. We think that we've got something that's interesting in a different way, in an actual way that an advisor could actually access hedge funds without necessarily having to make some of those really difficult decisions.
Okay. And then, so to be clear, what Aberdeen is providing is insight and diligence into managers to select the best underlying managers.
We do that, and that's what we do for large institutions. What we've built is the first ever full replication tracking product for hedge funds. So historically, to your point, the different liquidity profiles of different hedge funds is quite broad, and it can range from hedge funds that have weekly liquidity to hedge funds that will, if you can get into them, some of the big multi-pods are the favorites here, Citadels, Millenniums, etc. These sorts of guys. If you can get capacity, and that's a big if, because they're not handing out capacity to lots of people, but if you can get capacity, it will take you 4 years to get your money back. So that's just kind of the spectrum that hedge funds work around. What we've done is we've worked with the biggest benchmark company in hedge funds, which is called HFR, and their flagship index is called the HFRI Fund Weighted Composite, right? So that is the benchmark that most people use to look at hedge fund returns. And the problem with that index is that it includes all sorts of funds, some of which are open, some of which are closed, some of which are big, some of which are small. It's probably 1,500 different hedge funds.
Sure.
What we've done with them is that we've built a number of filters, which when you apply them to this broad, say, 1,500 fund index, you apply a number of different filters, you get a different index, which is called the HFRI 500. That is a fully investable index. So one of the criteria to get into this index is that you have to be open and taking new money. Another criteria is you have to be willing to take monthly subscriptions. And the other being is that you have to have quarterly liquidity. You can't have any gates in place either.
Interesting. Does this solve for some of the biases that we knew from before, like self-representation?
So that's another really, really good point in the sense that the willingness or the kind of skepticism around hedge fund benchmarks, because they are self-reporting, is well founded and is well known. This does solve for those issues. So if you look at the CFA's criteria for an index, they use an acronym called SAMURAI, and it has to be met. To meet some of those criteria, you have to be specified in advance, appropriate, measurable, unambiguous, reflective of the investment opinion, accountable, and the last one is investable. No hedge fund index previously has been investable. This is the first ever investable index, and we've been tracking it with live dollars for 2.5 years.
Amazing. Okay, and then this structure is available with Aberdeen in what kind of format?
It's a Cayman.
It's a Cayman fund.
So it's a Cayman fund, and the way that we've built this platform is that you can, if you just say you want to buy a hedge fund index as a proxy for hedge fund returns, you could invest in what's called the HFRI 500, which is the top level benchmark. If you've got a more nuanced view about hedge funds and where you might want to put your money, so if you take our, if you like, house view, we really like systematic macro, we really like event-driven funds, and we think long-short equity and equity market neutral are interesting also. Well, the structure that we built is, if you don't have a view, you just want some hedge fund beta into your portfolio, you could buy the 500. Or if you have a view, okay, well, I really like event multi-strat, you can go into that individual sub-strategy. If you say, I really like systematic macro, you can go into that sub-strategy. Now, why would you do that? Just because the return profiles And the characteristics that you get from these indices are quite different to one another. The top level HFRI 500 has got like a beta to equities of about 30 bips.
Wow.
If you look at the systematic macro beta to equities, it's 2 basis points. So you can start to see just from there, okay, well, you've got something different there, okay? You've got something that's actually a differentiated return stream. We all talk about uncorrelated return streams. We all talk about differentiated return streams. Really difficult to find them. And private assets are not differentiated return streams. Private equity is equity in a different form. Private credit is different, is credit in a
lending
form. Yeah, I mean, Cliff Asness talks about this. AQR, he talks about it being volatility laundering, which is obviously, I mean, it's just a really interesting way of putting it. So obviously, it's a bit out, yeah, it's a bit contentious. But my point is that, you know, these trading strategies, yeah, sometimes, I mean, long short equity as a trading strategy will have more, you know, it's got a high correlation to equities. But if you're an advisor and you have a view that, okay, you know, I've done so well out of equities, and I just think things are looking a little bit less interesting. I'm just a little bit less sure. Maybe a long short equity is a way to implement it.
Certainly.
It's less volatility. It's about 10% vol as opposed to the 15% vol, and they've got the ability to make money on the long side and the short side. Although making money on the short side is quite difficult.
Yeah, it really is. So correlation is important. And it's more important when when everybody's kind of looking to get to the door at the same time, because the only thing that goes up is correlation during a sell.
So this ties into this point entirely. It's as though we scripted this, right? Which we didn't, because we met 5 minutes ago. The thing here is that this is data that we can share with you and your advisors, etc. Is that if you just look at the average return of these different sub-strategies in different environments, when you look at high volatility regimes, discretionary macro, systematic macro, volatility RV do really well in high volatility regimes. And just taking VIX at over 20 as a high vol regime.
Sure.
In just low vol regimes, unsurprisingly, long short equity, event-driven multi-strat does really well in those types of environments. So this is all, the interesting thing about this is that, again, you can look at because these are indices, you can look at we've got track records going back to 2005 of the indices themselves. HFR have gone through their databases and recreated what these indices would have looked like using the same methodology. So you've got something that you can put into an optimizer and say, is this going to help my client's portfolio?
Right.
This is all, and you know, again, we can help with data and all that sort of stuff. But you know, you are putting something that's maybe a bit different. It's not always going to be up. It's not always just going to be up in a straight line. It's not, you know, there's intricacies to this, right? But it's a different opportunity. Now, the previous way to get exposure to hedge funds, unless you did the due diligence yourself, would be to go through fund of funds.
Right.
Now, again, if you look at fund of funds, it's the same as hedge funds. There's really good fund of funds, and there's not.
Right.
We're a really good fund of hedge funds, but we don't have a commingled product. But the thing is, when you look at the index, the HFRI 500, relative to the average fund of fund, it outperforms by about 100 basis points a year.
Wow.
The HFRI 500 outperforms the average fund of hedge funds by about 100 basis points a year. Now, that's not every single year, it's not guaranteed, etc. But that's what it does. Now, the reason that we've done kind of a regression analysis as to why this would be, and it's predominantly down to fees. The average fund of hedge fund charges another 100 basis points, potentially some performance fees over and above the hedge funds, which are also charging
220s, but kind of
220s.
Has that come off a little bit?
Not if you're Citadel, not if you're Millennium. They charge whatever they want.
Sure.
But if you're the average hedge fund, yeah. So the average fees in this index are something like 130 and 17, something like that. So definitely down from the 2 and 20.
Okay.
Now, again, this is a net index, so everybody reports they report their returns net of those fees. So the number that you see, what you need to be concerned about, in our opinion, is what fees we're charging.
Yeah. Right.
Because obviously, the fees from the hedge funds have already been charged. The index is already net of those fees.
Okay.
So, I mean, our fee now again, this is a platform that's, I mean, it's coming up for a 3-year track record this year, but it's set up. At the moment, it's not set up with trailer fees or anything like that. But if you've got a fee-based client, you can get into this this platform. At the moment, you can get into at 20 basis points. Minimums would need to potentially work on with different with you as a firm.
Sure.
But it's 20 bips at the moment. At some point, that'll go up to 30 bips. But at the moment, we're very keen to get to raise assets. At some point, we'll become less keen. But this thing can be 10. I mean, it's at the moment, the entire platform is about $600 million. The bulk of which is a tracking product that we have for a US state pension plan. Within this index family, there's about 150 million in this index family. But this could literally be tens of billions of dollars.
Yeah, there's no capacity for these liquid.
Which is just another thing about hedge funds, is that generally speaking, if you've done all this research, if you've done all the work to identify the best hedge funds, you then still have to be able to get in and get capacity, and all of those things are really difficult things. Things to do. This is a way around it. Another thing being is if we, if you say you or one of your advisors has got, Millennium or something like that in their fund, I mean, don't sell it. But this is something that you could put alongside it. And when you want to sell this, we prefer it if you stay, but we don't care. You're not ruining your relationship with the manager that you've already found.
Right.
So and like I said, it is genuinely, and I mean, I've been in the industry for over 20 plus years. It's very rare that you can say something that is genuinely unique. This is genuinely unique. Nobody else has done this before. There are funds that have, like Goldman's, other large New York-based banks have tracker products, like in 40 Act or UCITS or whatever, but they're not investing in the underlying funds, right? They're investing in the
factors that get you there.
Exactly. Okay. The use factors.
Yeah.
And this is not that.
Okay.
It's literally, say there's 400 funds in the index. What do? We invest in 400 funds in the index.
Wild. Yeah. Wild. When we look at,
strangely simplistic though.
Yeah. When we look at this space and we contrast it to other assets in the private market and alternatives bucket, let's talk about dispersion. Let's talk about persistence of returns, and if there's any, predictive values in, if you did well for 5 years and 10 years, are you likely to be in that same bucket of outperformance versus?
It's a great question. The persistence is relatively low.
Yeah.
So again, let's say you've got the research capability, you found the fund that you want to invest in, you've negotiated capacity, you've gotten in. The likelihood of that fund staying at the top is relatively low. It depends on it's different on different indices, but if you look at it on, say, let's just say the discretionary macro space, the chances of you being top quartile, if you're top quartile 1 year, the chances of you being top quartile the following year is about 40%, and that's quite high actually. But there's 60% chance that you're not.
Yeah.
Right. The kind of concept of the level of dispersion again depends on the sub strategy. There's probably lower dispersion in systematic macro. There's probably lower dispersion in some of the event-driven sub strategies. There's really high dispersion in things like long-short equity. There's quite high dispersion in discretionary macro. So those again are the things. But the reality is, it's not just the small funds that blow up. It's not just the new funds. Like some of the really, really well-established funds have terrible years, but that's hedge fund investing.
Yeah.
And that's why actually doing one of the things that you're removing by using an index is you're removing the need to do the due diligence aspect on the underlying manager. So you're making a decision, okay, it's probably going to be because you want to diversify your client's book.
Mm-hmm.
But I don't, the reality is that the return, the indices are not delivering the same sort of double-digit returns as private credit or private equity potentially. Well, some of the underlying indices are, but it's not like the HFRI 500 is not. It's more like a 500-600 basis points sort of return historically. We think that will be better going forward.
Okay.
But ultimately, it's not, you're probably going to be doing it because you want some sort of diversifying assets in your portfolio.
Oh.
But once you then start to do that, there's definitely there's tactical tilts that you can take, or you can you can try and be a bit more precise with the types of exposures that you're taking. But ultimately, that's the decision you need to then make. You don't then need to go and find a fund manager that's going to express those views. Making a decision as to whether to invest in systematic macro is quite a difficult decision to come to. Having to then find a manager that will definitely deliver for you when you need it to.
Yeah,
that's another thing.
That's another.
So, did your manager deliver for you in 2020? That was when you really needed it.
Yeah.
That's when you really needed it, right?
Yes.
A load of them did, and the systematic macro benchmark was up 17% in 2020. Was there a bunch of funds that were up further? Sure. So there's distribution of return.
Sure.
But there was also a bunch of funds down here as well.
Yeah.
Now again, the dispersion around systematic macro is a lot tighter because there's differences between one and the other, etc. One manager and another, but they're similar. There can be similarities, but again, there's lots of different use cases as to why you would think about hedge funds. The two things I would really emphasize is just that, it's probably because you're trying to put some sort of differentiated return stream, whether it's just lower beta or something that might do well in a more difficult environment.
Mm-hmm.
The other point would be is that yes, the returns are being low, but that's also coincided with a low interest rate environment as interest rates have gone up. And the knock-on impacts on markets, the return opportunity for hedge funds going forward is genuinely now is as good as we've ever seen, as good as we've seen in the last 20 years.
That's exciting. Really great answer to a very broad question that encompassed a lot of moving parts. And I just go back to a famous quote that I heard. It's like poker. It depends. Okay? Can't put a rule to every.
No, and that's the thing. And you just, I think we recognize that. Say, if you guys as a company you've got, and if your advisors have got interest in this, we'll commit to supporting you with education on helping you understand what the different types of strategies are, what they might be able to do in your portfolio. We should, we'll be able to help you out with data so that you can actually use some of that. This is really, myself and Kevin are here really is just a viewpoint. We've got 2.5 years track record. Our realized tracking error is over the 2.5 years across the 9 different funds. The average monthly tracking error is 3 basis points positive.
Wow.
So we've actually, net of our fees, we've actually marginally outperformed the index.
Incredible.
Which is a fee thing. It's not. It's just what hedge funds do, and this goes back to your point around skepticism about benchmarks. It's what these are self-reporting.
Mm-hmm.
So hedge fund managers report their own numbers. So they report the most expensive share class.
All right.
If we can negotiate our way into a cheaper share class, then that's alpha.
Correct.
So that's kind of where, as we grow, we'll be able to get into cheaper share classes.
Mm-hmm.
So that's how we expect, we hope and expect to be able to deliver a very close tracking error to the benchmark.
Mm-hmm.
by negotiating into cheaper share classes.
Okay. So we dove into the hedge fund land. Let's take a step and go back to the macro view, looking at Aberdeen's house view. We mentioned at the beginning, you guys are excited about real assets, matches with our house view.
Yeah.
From your seat as a head of alternatives at Aberdeen, what within real assets should we specifically be focused on?
Yeah, I think just take a step back from that, just in terms of just right across the piece. Like I mean, generally speaking, we think that actually this kind of environment where we're still relatively positive about risk assets is still positive. The outlook for risk assets, more generally speaking, is still relatively positive. The tricky thing with it is two things. One is the administration in the US is potentially less predictable than the previous administration. So, I think just most recently, the tariffs, which had been well signposted during the entire campaign, when they were announced, the markets sold off pretty aggressively. So maybe they were underestimating how much the administration was going to follow through from the campaign. That has introduced a degree of a higher degree of uncertainty, which, again, whether or not that's even, you could say, well, the kind of America first approach will benefit America, but actually, some of that we think could be quite inflationary and actually keep interest rates higher.
Sure.
Tariffs, all these sorts of things. So, but overall, we're still relatively constructive about risk assets. But my point is that there are some issues from a kind of macro perspective, geopolitical macro perspective, which means that the outlook is less certain around that, and the last couple of days has kind of increased the uncertainty level there. The other thing is just just given the returns and given where we're starting today on a valuation perspective, future returns from equities are they're just lower.
They have to be muted.
They're just lower.
Yeah.
And it's the same thing. You don't need to be an equity strategist to come up with a view that if your Sharpe ratio has been at multi-decades high, that might come down. Now that might be because volatility goes up, or it might be because return comes down, but it's a reasonable bet to feel that that's going to come down. So that's our thought process around, because everything's relative. So, that's a kind of driver there. So within real assets, it's not a core area of expertise in terms of real estate and infrastructure. We do within our multi-asset and alternatives space have a what we call our diversified assets product, which is a daily liquid UCITS type fund. And is that fund does like infrastructure in particular. Real estate's a little bit more pointed in terms of where specifically. So where to stay away from, where to look at. But we do definitely, as a house, we do definitely like real estate, but it's still on the cusp of, you have to pick your spots. Infrastructure as an asset has been quite a poor performing asset of late with the inflation and the kind of the impact on the kind of the impact on returns, the potential impact on future returns there. But it's an asset class that we do still really like. So it's an asset class that we're, on our real assets teams, we know we're doing a lot of asset raising there. Within our multi-asset context, it's probably the biggest exposure in terms of risk assets is in infrastructure. Correct, yeah. Within the hedge funds, which is where I spend most of my time, our biggest focus is on systematic macro, event-driven funds, and lower net exposure long-short equity funds.
The appeal of infrastructure, more predictable outcomes, inflation protection, privileged market position, highly structured, a little bit more organized way to get to your destination. But it's interesting that infrastructure assets have underperformed.
Yeah, I mean, particularly because you talk about that inflation protection, which is, I mean, it's true, but it's the adjustment that's where infrastructure assets and the perception around infrastructure struggle. Just because if you start with a higher valuation point, if your interest rates are higher, your risk-free rate's higher, then you're basing all your numbers off a higher interest rate number. Your inflation protection comes from the payments over time, where a lot of infrastructure has kind of some sort of linkage to inflation in the payments. That's where you get that inflation protection from. But the readjustment was kind of quite a painful one for particularly for this was in particular in our diversified assets portfolios. We're accessing infrastructure through think about it, it's a similar structure to a REIT. It's a listed asset, and equity markets, as we know, price things in instantly.
Sure.
Whereas again, if you're investing in the underlying infrastructure asset directly, you've not got liquidity, but you get that smoothing effect in it. So that's probably the distinction I should have made.
Interesting. Can't believe we're almost on 30-minute mark here. Time flies when you're having fun.
Yeah.
So global specialists, emerging market, you guys have a wonderful frontier emerging market debt fund.
Yeah.
Any closing ideas, thoughts as we come to a close?
Well, I mean, I think our hedge fund portfolio and platform is really great, but I've probably talked about that for 28 minutes. But I don't know if, I mean, I know where Kevin's kind of looks at things more generally, so maybe I'll pass it.
Yeah, no, thanks, Tim. Thanks, Alejandro, and of course, everyone for joining. Yeah, really appreciate your time. Yeah, I think as Tam mentioned, this product, we're trying to get it on the Pershing platform. Super interesting, strong team. Of course, Aberdeen has, fixed income products. We have a good US small cap fund. With this HFR strategy right now, we want to kind of diversify away from fixed income. Last year, fixed income was great. We don't know this year. So rates are going to stay higher, of course.
Higher for longer.
Yeah, exactly. So this strategy is super interesting. Great to get him down here. Trying to get on the Pershing platform. So of course, with you guys support, we love that. And from there, we can always provide more data, provide you the presentation deck, and always here to help, of course.
Thank you so much.
Yeah.
Team, killer outlook piece, great slides, great resources for us, and more to come with Aberdeen.
Yeah.
Tam McVie, thank you for being on the show.
Thanks so much for having me.
It's great fun.
Yeah.
Thank you.
Thank you, everybody. Yeah.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://